We think 2017 will be a year of sparkle and fade, where the first quarter is one where things will still feel pretty good. Inflation data is picking up. Earnings data will show very strong growth. I think as you move past the first quarter, that gets much harder. If I have to characterize the majority of investors I speak to, they're relatively optimistic on U.S. policy delivering a very positive outcome for U.S. assets and U.S. equities, and they're quite concerned about a heavy political calendar in Europe driving risk, especially for European stocks. And frankly, we see that as the other way around. We prefer the European equity market to the U.S. equity market for a couple of reasons. We think that in Europe, those political fears create a low bar that is very easy to clear, and that this could be the first year in the recovery where earnings in Europe grow faster than the US. At the same time, US equities and US assets are having to deal with a very strong dollar, which will be a headwind to earnings, and the problem that when expectations are very high for what policy will deliver, it's much easier for those expectations to be disappointed. Looking farther afield to emerging markets, we think some nuance is required. Growth is going to be better, inflation's going to be better, monetary policy is going to be easier, but you have a Fed that's hiking rates and a stronger dollar and an increase in protectionist rhetoric. All that means that differentiation between strong fundamental stories and weak fundamental stories is likely to be a big deal in the year ahead.